to be doing beginner Fibonacci, intro to Fibonacci. Just want to point out take a minute here to read our risk disclaimer if this is your first presentation. Of course, trading in general, but especially with currency markets with high leverage is a risky venture, and also exposes you to significant losses. We also don't want you to take what we say here today and go out and trade immediately upon it. Hopefully you take the tools that we teach you here today and use it within your overall strategy and find a trading system and style that suits your personality. Okay, first we're going to look at the origins of Fibonacci. Where does it come from? Just a little background on it and why it has significance. We're going to look at how they impact and where their place in technical analysis is. We will look at how to use it in long-term trading and also how to use Fibonacci retracements and other things in your short-term trading. Fibonacci first was introduced, the name comes from Italian mathematician Leonardo of Pisa, whose nickname was Fibonacci, and that means son of Bonacci, which was his father. He introduced it into Western Europe in his publication Liber Abaci. That was in 1202, so you can see it's been around for a very long time. It was previously described in Indian mathematics, and that was based on Sanskrit prosody, which is looking at the syllables where one long is 2 and short is 1, and you'll see where the 1 and 2 comes into play as we go forward. But the point here is that this is something that's been around for hundreds and hundreds of years. It's been, and the fact that it's still being used today should give it some validity and something of importance for you to use in your trading. The first thing you want to know is that Fibonacci it's a number sequence, and the numbers are basically you add the prior two numbers to get the next number, and then you just go forward. 0 and 1 is 1, 1 and 1 is 2, 2 and 1 is 3, 3 and 2 is 5, and so forth and so on. And this is a sequence that has a divisibility factor in it, and that's where we get our percentages of it. And basically each number in the series equates to 1.618 times the previous number. And that's where we get the 61.8, which is the golden ratio, which is one of the most important things in Fibonacci trading, and we'll get into that as we go forward. But looking at where we get some of the other percentages from, and the 61.8 is dividing the previous number, but if you divide the next number prior to it, so say you divide, say 5 by 2, you will get the 38.2%. And then the 23.6 is just dividing the third number. The 50% is not technically a Fibonacci percentage, but since it's a half of the move, and we'll go into that as we go forward, it's been added into it. And so you'll see the main percentages that we look at in Fibonacci are 23.6, the 38.2, the 50%, and the 61.8, and that gives us your percentages, your key percentages that we look at. Another thing to notice in Fibonacci, it's relevant in nature. It has relevance beyond mathematics. You see these relationships in branching in trees, fruitlets in a pineapple, arrangements of pine cones, and also in sunflower florets, as the picture we have here. So just adding more validity to its significance as we see it's been around for a long time and it has very significant. The golden ratio. is the main ratio that we want to look at in the Fibonacci. It's the 61.8, it's the division of the one before. And you can see here, this is a geometric representation of it. Basically, the width of one side of the square is the 61.8 of the next box, and like every major number sequence, it's defined by linear recurrence. It's a closed form solution, which means that it's a simple formula that's included within that linear the linear line that we showed you with the numbers. So I'm sure you all didn't come here to find out the history of Fibonacci and where it came from. You want to know what does that mean for you in trading currency markets. We just wanted to give you a little background just to emphasize that there is some significance of it beyond just the percentages that we put out there. And as we go forward, we'll show you that. And so Ilya is going to start off by looking at some of the long-term implications of using Fibonacci.
Okay, so first off, can everybody hear me okay? Back there? Okay. So obviously, markets don't move in straight lines, right? And even though they may trend in a given direction, they don't necessarily trend in that direction all the time. And as we can see here, we have a period within an uptrend, in this case, where prices correct lower. And the trick is, obviously, to find that spot, to find where that correction is over and when the overall trend begins again. And if we look at a downtrend, we see exactly the same thing. We have an overall trajectory lower, but with periods of correction. And the trick there is obviously locating that and seeing where that turning point might be to jump back into that trend. Now, as we've broken down here, this point A, which is delineated there at the bottom, is essentially your first leg of the trend. Okay, so that's your first move higher. Right as you get to point B, you essentially create a situation where the traders that wanted to be long are essentially already long, and the price has gone up relatively significantly and is no longer attractive to bring in new buyers. Now, it also means that the people that are already long have been long for a while. They've seen some profits and are probably getting a little bit more sensitive to news that would threaten this trade because they obviously want to protect those profits, right? So if we get some sort of news that counters the logic behind this up move, those people that are already long are encouraged to take their profits and to get out, which creates this correction down. Now, once we get the move lower, those people that wanted to be long but didn't because the price had already essentially become too expensive, all of a sudden the market starts to look a lot more attractive because now the price is obviously lower and it's much more interesting to get back in. And those same people that may have taken profits earlier see this correction running out of steam and get back in. And that's what perpetuates the trend higher and creates newer highs and newer highs. So what Fibonacci analysis essentially will address is where this turning point is, where essentially a trader can say, this correction is over, I want to get back in. Okay? The key here is that this is used for trending markets. Okay? Because the logic of a retracement is that it is a pullback against the trajectory of an established trend. So you don't want to use this necessarily for range-bound trading or trading where you can't discern a clear trend. Okay? Now, setting this up and actually using the analysis is very easy. It's a simple two-step process. You essentially identify the beginning of a single move in price. In this case, right here. Okay? You identify where that move began to move in the opposite direction. Okay? Assume, of course, that none of this is here. Right? We don't know this yet. What we know is that price came from here, here, and started to move higher. And what we want to know is this a reversal or is this a correction? And what we do to find that out is we draw a Fibonacci trend line, which is available in every single charting package that's out there at this point, and certainly available with the charts that come with the FXCM trading station. You can see these levels, these same ratios that John was talking about, that essentially identify where the price could retrace. And what we see here is it pulls right up to a Fibonacci level, stalls in between them, and the trend continues. Okay? Now, the great thing about this tool is it's useful across time frames. If you're looking at a daily chart, at a weekly chart, I tend to be more of a long-term trader. John tends to be more of a short-term trader. And we both use this in exactly the same way across time frames, and it is no less effective. For example, here's a weekly chart of Kiwi dollar. Okay? And what we've done is we've taken and drawn this trend line from this bottom here all the way up to this top there, essentially capturing this entire up move. Now, if you were a short-term trader, you could draw something here, just here. But in this case, we want to go long-term. So we're going to take a look at this entire run here. Okay? And as we can see, we get a textbook retracement to the 61.8% level, which, as John mentioned, is essentially called the golden ratio. It is what all fib numbers are divisible by. And from here, the trend resumes higher. Obviously, each one of these bars here represents a week. So we're looking at very long-term charts here. Okay? So there's our initial advance. There's our 61% pullback. And right here, the uptrend resumes. Okay? Same ABC pattern that we saw before. Okay? Let's go longer term. Monthly chart. Each one of these bars represents a month. So we're talking about several years here. Same logic. There's our initial advance. There's the pullback down to the 38.2% fib. And once again, the uptrend continues. This is a monthly chart of pound dollar. Okay? And what John will talk about is applying this now on a shorter term time frame and how you can use that in your trading.
Exactly. I'm sure everyone here trades on a little shorter time frame than Ilya does. So just looking here, this is a 5-minute pound-dollar chart, and Fibonacci levels you can draw on pretty easily when so you can, even in a short time frame like this, you can lay out those levels for yourself and target those levels. And you can see here we had an advance in the pound dollar to here, and we had the 50% retracement. Now we can see here, even at the 38.2, we saw price action starting to slow. So say you're a trader, you had been long here, and you start looking, you see this nice big wick here, and you're saying, wow, that's an indicator to me that price action might reverse. And it does. And you get short here. But how long do you keep the short position? You might want to set your first limit to that Fibonacci level. And look, you're going to capture this profit here. And beyond that, over the next few days, there's really not that much price action going on. So if you had gotten into this trade here, you would have been able to get out at this level, take your profits, and over the next few days, you really hadn't missed much going on in the marketplace. But if you want to be aggressive, you like this, or say you're using money management principles and you move down your stop, you can still see there's more downward potential to the 50.0% level, where we saw price action again slow, and we saw a reversal. Now I want to talk about when we start seeing these consolidation levels for a short-term trader. This is another one on a daily chart. I'm going to get back to the consolidation periods on the next slide, but you can see here on a daily chart, just to break it out a little bit longer. Again, we saw the pound dollar advance. And what I like to do is target these levels. You can see here there was the retracement here. And then again, so you have some confidence in this level that it's a solid support level. So if I am getting short again here, then when we start approaching this level for a second test, I'm not going to be as aggressive. I'm going to start looking to take my profits off the table, because I've seen this level already hold here, and that gives me confidence that it's a pretty solid support level. And so I like to use Fibonacci levels to target them. Yes?
How did you pick when did you pick the peak? Why did you not pick one of the peaks earlier?
Well, you can use it. You can use it at this point here. It's just that of course, we're using hindsight here, but.
That's what I'm saying. This is hindsight.
But I would use this if I would identify this longer daily trend, and then use this. I might have put the peak here, and from here to here, there could be potential retracement there. It's just using this daily chart, but you'll see, even if you don't know that this price action is coming about, this could have been a level that you used, but you saw the continuation. So, it's not a foolproof, but you definitely want to use these levels as levels to target for support or potential resistance. And if you've been trading for a long time, and as long as I've done it, you'll see that these levels, they don't always hold, but they are key. And you can see here on the second test of this level, we saw some consolidation. And then when it eventually broke below, we got a breakout to the downside. So by identifying this support line here, you can see that a break below it increases your bearish conviction, because you're saying, I see this level. It's identified it as a strong support level. It's a Fibonacci of our major retracement, of our major trend here. And now that it's broken below, I can have greater conviction that the bear trend that we're seeing develop here will continue. And I bet if I drew a Fibonacci level from here, from here to here, this could be a potential resistance level here, and that's where you saw the resistance here. But again, like going back to that daily chart, you can see that you want to look at the 5-minute chart. In the context of that daily chart, you might have drawn some of those levels in here in your 5-minute chart, and those are levels that you want to target for support resistance. Another way you can use Fibonacci, if you're an intraday trader, you're a scalper, you want to capture small profits, but you don't want to be involved with you're afraid of a breakout or a longer-term trend developing. You can see here, by identifying this Fibonacci level, you can possibly anticipate that a failure at this level can generate a period of consolidation, because what you're getting here is markets deciding whether that this trend is indeed going to go lower or if it's just the small retracement, and then we're going to see the extension of the longer-term trend continue. So that period there is where you can see some consolidation, and if you see we took this price action here and we broke it out here, and for a scalper we see there's a very identifiable channel here that you can use to establish as some target levels for you to use as a scalper. If you're trying to capture these small moves here on an intraday period, or on your 5-minute chart. So these levels, not only you use them for targeting levels for possible support and resistance, but also to identify periods where you might see price action consolidate, where you see markets start to debate whether the trends are going to continue or end. And they're going to allow you to identify those periods to possibly use different strategies like scalping or range trading. Again, they're not, like they said, not specifically used in range trading, but they can help you identify periods of concentration where you can use range trading strategies, and you can also use scalping strategies. So basically those are the brief overview of Fibonacci.
We're actually going to go ahead and wrap up here because we have to make way for the next class.
Yeah,
but definitely you can track us down. We're at the Daily FX booth. We'll hang out around the door here if you have any extra questions. And by all means, feel free to just send us an email.
Yeah, all of the Daily FX analysts, all of our emails are our first initial, last name at fxcm.com. So I'm Jay Rivera at fxcm.com.
And I'm Spivak at dailyfx.com or fxcm.com. Feel free to contact us. We try to get to everything as soon as possibly feasible. So by all means, feel totally free to do that. And thank you.
Thank you.